Bank freezes and new transfer taxes, how your access to money is changing. Banks now have broader legal protection to freeze transactions they deem suspicious, and new rules and taxes introduced in 2025 to 2026 have increased the frequency and impact of account holds. Many states enacted safe harbor laws allowing banks to pause transfers for up to 14 business days on mere suspicion of financial exploitation. Because banks enjoy immunity, they often opt to freeze questionable activity rather than risk liability, producing many false positives and leaving customers without access to funds for days or weeks. Modern fraud detection uses contextual monitoring and behavioral analysis. Systems flag out of pattern activity, large or atypical transfers, new recipients, out-of-state or international payments, unusual device fingerprints, or logging in while on a call. These criteria can catch real scams but also legitimate transactions, helping family, paying contractors, or buying a house, which may be frozen pending review. For people on fixed incomes, joint accounts, or with limited alternatives, a 2-week hold can cascade into missed bills, disconnected utilities, or unpaid medications. Several legal and regulatory changes amplify these problems. A new 1% federal excise tax on cash-funded international transfers, effective January 1, 2026, taxes cash, money order, and cashier check remittances while exempting digital bank-funded transfers. This penalizes cash users and disproportionately impacts immigrants, rural communities, and elders who rely on physical transfer channels. At the same time, peer-to-peer and payment app reporting thresholds have tightened. Platforms must report merchant receipts hitting lower thresholds, increasing IRS visibility into account activity and triggering additional scrutiny when transactions don't match tax filings. Other freeze triggers include IRS levies for unpaid taxes, garnishments on joint accounts when a co-owner faces legal action, dormant account escheatment after prolonged inactivity, teller or branch hold policies on large cash withdrawals, device lockouts when logging in from unfamiliar devices, and mandatory cool-down periods for new recipients on payment apps. Branch closures and reduced cash availability compound the issue, making immediate access to larger sums harder even when legitimate. Practical steps to reduce freeze risk. Notify your bank in advance of large or unusual transfers and get a note placed on your file. Use in-branch appointments for major withdrawals or cashier's checks. Avoid joint ownership. Use power of attorney or beneficiary designations instead. Keep accounts active with occasional transactions to prevent dormancy. Use digital bank-funded transfer services to avoid the 1% cash transfer tax, and separate personal and business accounts and maintain careful records for payment app income to meet IRS expectations. There are trade-offs. Greater surveillance reduces some fraud but increases false positives, erodes privacy, and shifts discretion toward institutions whose priority is regulatory compliance and liability avoidance. Vulnerable groups, seniors, immigrants, low-income and underbanked households, are most exposed. Consider holding a small emergency cash reserve accessible immediately, while recognizing the risks of physical cash. For complex situations or repeated freezes, seek legal or financial advice to protect access and challenge wrongful holds.